Looking for the best opportunities in Perth property? Get the local area expertise you need from Momentum Wealth, WA's trusted property investment consultants. Market insights, advice and representation from award-winning buyers agents and REWA Hall of Fame inductees. Visit Momentum Wealth's website at momentumwealth.com.au to organise your obligation-free consultation today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome back. Thanks for tuning in. I'm afraid Phil Tarrant is not available today, so this is Alex Whitlock, his business partner, stepping in, taking an opportunity to delve deep into a couple of interesting characters in property investment. A couple of guys have been around for a very, very long time, and many of our regulars will be familiar with Cameron McLellan and also Michael Beresford. They're directors of OpenCorp. These guys have been on the show a number of times. They're also on our channel with the Australian Wealth Builders. Guys, great to have you on the show again.
Thanks for having us. Fantastic.
Be here, Alex.
So, Cam, starting with you, it's been a tough time, but before we get into sort of what OpenCorp is doing at the moment and where you're looking in the future, been really, really tough looking back over the last year, particularly with COVID. And you guys both based in Melbourne. How's that been for you?
Melbourne's been fantastic. I love being locked in the house with the family 24/7. No, we're very, very glad with our recent numbers and the way things are. The consumer confidence obviously was down throughout the lockdowns. A lot of retailers hit pretty hard. Property sentiment's back strong, and I think the economy is really starting to pick up, which is good. So there's a good feeling through Victoria at the moment, and we've obviously got team members across multiple states, so it's been good to have that interaction. But I'm sick of Zoom meetings, mate. I'll tell you that.
Oh, mate, I tell you, so I think everyone's zoomed out, and everything's a webinar this and a virtual that. It'd be great to get back to normal life, and I hope sometime next year it's not going to be very far away. But it has been a challenging year, and I think one of the things that's hit Australians really from, sort of looking back over the course of the year, it's really been sort of psychological as much as actually economic. We've done pretty well economically, but there's sort of a real psychological sort of slam to the body in March. What have you noticed in terms of sort of trends with your clients around that time and sort of just really sort of looking through, I guess, the last sort of 6 to 8 months?
Yeah, I might get Michael to elaborate, but what we did early days, we understood what drives the property market being supply, demand and affordability. And there's a number of factors that fall under each of those. So having a data and analytics team and obviously the resources for a lot of economists, we understood what sort of stimulus was going to be put in place, and therefore we're trying to predict early days. And I might let Michael elaborate because he had the task of dissecting what our propeller heads were bringing in as far as data and trying to put that into a fashion and deliver that information to our clients in a way that we were predicting what the next government legislation changes may be, and then what that would mean to the property market. So when we've got our property management business, we've got 1,500 properties under management. So while most businesses in March were winding down, we had to triple the amount of staff to take the inquiries from our 1,500 odd landlords calling in and the 1,500 odd tenants all calling in at the same time to answer their questions on what was going to occur, let alone our investment advisory business with everyone wanting to know what was going on in the property market. So it was for everyone else who was winding down. Unfortunately for us, it was game on early days. But how did you cope, Michael, with that sort of information flow?
Yeah, look, it was a really interesting kind of 6 to 8 weeks through March, April, May. It was probably 50 or 60 phone calls a day, having the same kind of conversations with our clients. And I think the big takeaway is that humans hate uncertainty. And if we think back to March, there was so much uncertainty around not just coronavirus, but what it meant, how was our lifestyle going to be impacted, what was it going to mean for our job, who was going to be working, who wasn't, et cetera, what it meant for the economy, how the government had stepped in. So many questions that people had. What we realised we had to do was very quickly distill it down to the basics for our clients to help them understand what was actually going to happen and why. Call on all of our experience over the numerous upturns and downturns of recent decades, of which there have been several, and put that into succinct information for them, because clearly the mainstream media was having a field day with attention-grabbing headlines on markets crashing and unemployment rates and so forth. Really just trying to bring it back to what are those fundamentals that influence the property market? How do we see them staying the same or changing or evolving over the time ahead? And, very happy to say that the not one client was freaked out by the market, sold and has, been missing opportunities. And we always talked about the upswing that would come on the other side. We've seen a lot of indicators around that, lending policy, government stimulus, over and above JobKeeper and so forth to really put the economy on idle that has the property market well placed for 2021. Specifically, what we did was for the first 6 to 8 weeks of COVID, we did a weekly video out to clients, very data focused, very factual focused. And it was just a touch point and consistent commentary on what we were seeing as announcements were unfolding. So they understood the impact of those and could be a little bit more shielded from the attention-grabbing headlines and white noise, as we call it.
It's really funny. You mentioned the media. They are either licking the boots of the property market or they're spitting venom. And I've spoken to many investors and also, sort of property professionals over the years who get very upset with the way the media go. But I think you've got to understand that the media is there to sell stories and to get your eyeballs stuck on whatever channel it is that they're promoting. They don't have a love or a hate for the property market. They will just go from one extreme to the other. And they will also, they'll go along and they'll pick up, whatever the bank and the major lenders are forecasting in terms of, and a forecast is a forecast. And you'll get, you've had from the major banks, sort of 10% drops and everyone gets very concerned about that. I think it's interesting, to cast our minds back and look at what happened in the stock markets. I mean, they went down, like a lead balloon. But there was, there've been some adjustments in terms of property, but, we were on the back of a resurgent. I know that each market behaves differently, but in general, we were on the back of a fairly resurgent market across the board. And so this was a very unusual interruption to what was looking very, very positive in terms of the property markets.
Yeah, you've hit a nail on the head when it comes to media headlines, Alex. I think one of the classic ones, and we've got a new book out, which Michael and I co-wrote together, Investing in the New Normal, which has got a major PR campaign rolling out pre-December. But in there, actually, probably pinpoint that, some of the headlines that were rolling out, property values plunged during COVID pandemic and then price drop. And this is one of the daily misleading headlines you expect to see during times of uncertainty. The factual data at this point in time was that land in affordable suburbs where we invest increased by over 10%. Sales rates were up over 400%. So this is June, right in the guts of the pandemic. But due to the apartment market and a number of affluent suburbs, we saw the median measurement drop. So in Sydney at that point in time was 0.8%, Melbourne was 1.1%, Brisbane 0.4%, Adelaide 0.2%, Perth 1.1%, Hobart, Canberra, Darwin all recorded increase. So we expect this shift in the median measurement. The media use obviously words like plunge to invoke fear, and that sells stories. So it's clickbait, and that's really what they're after. So it's frustrating for long-term investors because when the market turns again, by the time the property prices have started to move over a year or so, it takes the media a while to jump back on that. Then they start reporting good newspaper articles because they go from doom to boom. There's only the two. The market's ticking along, doesn't sell articles. But then after the media's been promoting boom for about 12 months, your mum and dad or rookie investors jump onto the market. And so they're getting into the market right at the peak. So the media actually create issues for people investing at the wrong time of the market.
You're absolutely right. And I think it's really hard for beginner investors. People are just, at the end of the day, if you're buying your own home, you're still investing in property. It may not be for investment purposes directly, but it's still a major investment. And you get swung by the media and you get swung by, sort of forecasts, from the major banks. And the median property prices can be very, very misleading. It can imply big swings one way or the other. If you haven't sold your house, then it makes no difference. And your property value the actual property that you're in, if you were to sell it at a particular time, may dip theoretically. But if you don't sell, you don't lose, so it can be very misleading. How do you steer your clients through this kind of sort of fear-driven sort of environment around property market, different sort of fluctuations?
The way that we do it is we as Cam said, we have a research and analytics team as part of our business. And them feeding that information to us around the data and what we're seeing, and then our ability to be able to take all these complex numbers that, get reported in isolation and actually put it into a logical explanation for our clients is really how we were doing it. So that coupled with, I interviewed several chief economists and heard several others speak right throughout the COVID period. Andrew Wilson in particular, we had a chat third week of March that we revisited, and I spoke to him again a month ago, and everything that we talked about in that period of mass uncertainty happened, and everything that we talked about in October had subsequently happened, in the 6 weeks between then and now, specifically the cash rate coming down to 0.1%, New South Wales and Victorian governments really focusing on stamp duty as a stimulus for the housing market. So no one has a crystal ball, right? But when you have the formula and when you've been through the downturns and you know what the fundamentals are that influence property markets, and that's what you focus on, as opposed to the headline in isolation or the one data point in isolation that's reported, it really helps our clients kind of understand the fundamentals that drive them. One thing we were really big on was the fact that we would expect the median house price to come back a bit. And we gave the explanation that if the median house price comes back 3%, for example, it doesn't mean every house has lost 3% of its value. It means that there's a bigger impact at the top end of the market with fewer sales, which is to be expected when there's less consumer confidence. But there's still robust activity, as Cam was talking about, at the affordable end of the market. So just because the median shifts backwards to recalibrate the new middle, it doesn't mean that all asset classes and all property are affected equally. So it's that kind of depth of explanation and not just giving our clients the what, but why, that really builds up their knowledge base and helps them understand the fundamentals that we focus on.
I should add that we are probably the biggest and first people to talk about risk when it comes to investing. I think risk to me is the first thing I look at, not to the point where I get analysis paralysis, but this is what we were going through with our clients early days and throughout the COVID. It's going, what's the risk to your portfolio? Now, throughout the GFC and throughout COVID, we've been tested twice on our clients' portfolios and not one of our clients has been forced to sell. So if we look at, we've got 1,500 on properties in our rent roll, 91% of those properties weren't affected by COVID whatsoever. So 9% of the properties across the portfolio had a request for a rent reduction. They could then put in a dispensation claim, so actually put their mortgage on hold to offset the difference that they'd lost. So they were able to hold the portfolio throughout. And that's because we look for properties which don't take into account more than 30% of the household income. The 9% of properties that did see a rent reduction, as I said, they were able to reduce their rent. The 91% of people who had no rent reduction, because of interest rates, were actually cash flow better off through this COVID period. So by buying smart under the median house price in affordable areas, in infill areas and capital cities, we're able to de-risk that. Not investing in the apartment market was one of the first things we said was going to get smashed pretty heavily. And in the affluent areas, because you've got people renting that are using much more than 30% of their wages to go towards their rent, immediately they lost that rental amount. So I think our portfolio is probably a little different than the average, but it wasn't the impact that people were thinking. So that was some of the process that we were talking clients through early days, identifying the risk and then saying, well, based on that, what's going to occur and how does that affect you?
You're getting some crazy narrative back then, I think, but I'm a landlord. I've got, I'm joint portfolio owner with Phil, my business partner with the SPI portfolio. And there was some really, really bizarre narrative coming, back about landlords should be paying. And there's sort of a real lack of understanding that landlords have mortgages and are just as likely to go bust and end up in hardship as tenants who are struggling to meet their mortgage repayments. There were a few crazy statements back at the time. Luckily, common sense prevailed. I have to say the real estate industry did a fantastic job. The property managers out there did a really good job at looking after their landlords and looking after their tenants. Yeah. And we've all moved through. Look, we'll take a quick break just there and we're back in a couple of seconds.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Great to have you back with us. The reason I got you guys on, is I really, really value an opportunity for a bit of a snapshot as to what you see happening in the future and maybe delve into a couple of markets. But I think just to set the scene right at the moment, just give me a bit of a snapshot about what you see in terms of property, availability of funding, interest rates and so forth. Give us a bit of a sense of where we're at right now.
You want to go back a little bit, Michael, to 2017 and what occurred with the property market, where it was leading to, and bring people up to speed, because that'll give them a bit of insight into what's going to occur in the future.
Yeah, absolutely, Cam. And you mentioned, Alex, that the 8 to 9 months pre-COVID had been a pretty strong market. That's directly linked to these fundamentals that drive markets. So if we go back and remember that it wasn't that long ago, 2013 to 2017, the Sydney median house price went up over 90%. In that time frame. Now, that was the trigger for APRA to impose upon the banks some very significant lending restrictions that were designed just to slow the amount of speculative investment activity in Sydney. They couldn't come out and say that's what it was because that'd be discrimination, but that's what drove it. And because Sydney was the most expensive market, it had the impact sooner in Sydney than any of the other capital cities. As a result, we saw the median house price come back between 10 and 15%. And we saw a similar correction in the median, albeit smaller, in Melbourne, purely because that market was a bit more affordable and the lending restrictions still meant people could borrow enough to be able to buy a range of properties in Melbourne, but not the same range of properties and price points in Sydney. What's really interesting, though, that come June 2019, what we saw almost in perfect unison was Sydney and Melbourne starting to make up that recovery of the median house price correction for the 2.5 years before that. And what triggered that were three things. The first was the coalition was re-elected by surprise. Why that had an impact is because you might remember Labor took the removal of negative gearing for established properties to the election as a promise. So that meant that for several months prior to the election, some investors were sitting on their hands, taking a wait and see approach to what was going to happen. Once the coalition was re-elected and they knew negative gearing was safe, there was this influx of pent-up demand from the investors sitting idle in the months beforehand. The Royal Commission into banking, the results were handed down, lending restrictions were eased ever so slightly. And the third one you mentioned, interest rates came down and came down a lot. All of those things meant that the number of buyers in the market and the amount that they qualified to borrow increased significantly. So that's why we saw this rapid increase in demand. While we always talk about upswings coming after downturns, and right now, the opportunity is no different. So if I just mention I mentioned the fundamentals that drive property markets a couple of times. Those fundamentals are interest rates, population growth and supply, lending policies and government stimulus, infrastructure and spend. So if we look at where everything is lining up on those fundamentals right now, it's really appealing for property investors, and why there seems to be unanimous agreement that 2021, at least through kind of 2023, is going to be a really, really good time for investors and really strong price growth. The reason why we say that, and the reason why that view is so well shared and agreed upon, the RBA have come out and said that the cash rate at record lows of 0.1% is going to remain for the next 3 years to get the economy re-stimulated. So we know that with interest rates not moving anywhere, cost to hold are zero, properties will be paying for themselves. To answer Cam's question, what's the risk? You can be in the market without it impacting your lifestyle at all, provided you've got job security. From a population growth perspective, the border's been shut. We haven't had overseas migration the way that we typically know it. The overseas migration numbers are give or take a 200,000 net gain per year. We've actually had 379,000 Australians return home from overseas since March. So if you're understanding what the data means and what's measured, we've actually had more overseas migration this year than what we've had in previous years. As counterintuitive as that might sound, it's just in a different form. Obviously, supply to market has been dramatically reduced because developers are not as active, banks are not lending as much during downturns. So straight away, the supply and demand dynamic is the way that we want it. And from a government stimulus perspective, obviously there's been a lot of it. You can't inject hundreds of billions of dollars into an economy before we even think about quantitative easing and bond buying without seeing an inflationary effect over the years to come. And then finally, we've got the lending policies. And this is really, I guess, that's where it's most exciting for us. Aussie Home Loans announced in September that August of this year had been their biggest month for pre-approval volume for any month since 2014. So that tells that there's a direct measure of this pent-up demand, people realising the world's not going to end, realising that prices aren't going to crash, realising that interest rates are low and now's a good time to buy, and getting prepared to be buying during spring, summer and into 2021. Josh Frydenberg also announced that credit flow was critical for the economic recovery, and these significant lending barriers that have been in place, restricting credit flow and restricting economic growth and house price growth are going to be removed. That's not to be confused with the banks just handing money out willy-nilly. They'll still apply due diligence and normal process, but these massive buffers that they're required to assess you on today will be coming off. So straight away, that means, again, like we saw middle of last year, more buyers in the market with more borrowing capacity, with a commitment that interest rates will be low. That's the best way to summarise the opportunity over the next 1 to 3 years.
I think you're absolutely right. And I work in the mortgages portfolio at Momentum Media. That's my main beat, and very, very close to what's happening in terms of mortgage lending. And some of you tuning in may be familiar with the term responsible lending and the fact that government is winding back responsible lending, which sounds insane if you don't understand what it's based on. But this is basically really an over-onerous restriction on lenders, really sort of tightening up in terms of their ability to lend to borrowers. So what the government is doing is recognizing that things, as you quite rightly point out, Michael, that things have been tightened up too much, sort of 2-3 years ago. So there is a big move towards loosening up the ability to lend, making it easier for lenders to lend. And you look also correspondingly just around the lending landscape, and everyone is in the market and everyone is offering cash back. So you've got lenders that have got money to lend. They're lending it at record lows and with big incentives to borrow. You've got a property market that is primed for growth across, and we're not talking about one state or one capital city. You're really looking at many opportunities, in many areas, potentially over a prolonged period of time. So it really does look like a golden time for me. And, I've been buying property since 1998 in Australia. This feels like a very, very special opportunity to me.
Yeah, keeping the interest rate low is a very strong indication from the government. When government grants are released also is a big indication the government wants to stimulate the housing market. And a lot of people think that government grants are there to help the unworthy rich people of our economy. But what a lot of people don't understand is when the government puts in, if you say a $20,000 grant, they get around, I've done the numbers, about 37 times back of investment back into the market. So for example, if someone wants to buy a house for 750 grand, they can borrow 675. They need 112,500 to buy it. So 75 grand plus stamp duty. Say they've saved 92,000 thereabouts. The extra 20,000 gets them over the line. What people don't understand is the government, for that $20,000 payment that they give out, with stamp duty, GST, development infrastructure charges from local government, they get around 135 grand back. So the government love providing grants back to stimulate themselves and their own coffers as well.
We've got an economy that needs stimulating, and Australia is an economy built on small business, and many of those small businesses are in and around the building trade and suppliers to building. And you're absolutely right. And I think, look, one of the consequences further down the track will be, and the government knows this, is you're going to have a growth in property prices. They're going to go up. That's going to be a given, which is good news for investors.
Yeah.
Benefit is significant in terms of boosting the economy, boosting confidence, getting the market move. So it's all very, very well thought through and very, very measured, bringing first-time buyers into the market with incentives there. So yeah, it's looking like a very, very positive time to get into the market, or if you're already investing, to start building your portfolio. Look, we'll take a quick break there and we'll be back just in a few seconds.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back. What I'd like to do, and we talk to experts, and everyone has their own opinion on where to invest and where they focus. So I'd really like to get a sense for, over the coming period, where you are looking at for your investors, what you like about the market, where you think you would probably be avoiding, just a bit of an overview of where you think's looking good.
Yes, Alex, I think while we're more than happy to tell investors we don't hold our cards close to our chest, the city, the area, the suburb, the street we invest in, and we're happy to divulge the areas we go into. I think it's more important if we, and maybe Boz can go into the detail, and really teach people how to fish for themselves rather than feeding them. So to teach them how to reduce risk when it comes to investing, because that's the process that we went through. I was handed a strategy from one of our board members, Steve, who'd been investing for the last 50 years, 20 years ago, and I refined that strategy to the point where we use it now for OpenCorp clients. So it's probably more important to go, what are the risks? How do we invest, and what sort of result does it get? Boz, are you happy to divulge into that process?
Yeah, sure. So I like to keep things simple. The only two things we want from an investment property are growth in value and for it to bring in cash flow. Yeah, it's not whether we like the fence or not. There's no emotion in this. It's what's the formula and that blueprint to give us the best possible growth potential. And likewise, as Cam was saying, to mitigate our risk and make sure that the cash flow is always coming in the form of rent and tax benefits. Because if that happens, then these properties can just tick along in the background, grow over the long term. They're not impacting our lifestyle to hold. So not only is it easy for us to be able to hold one or two, but a much larger portfolio than that as well, if that's consistent with the goals that you want to achieve.
Capital growth and cash flow is the holy grail. It's what every investor hopes for. You will get certain advisors that will tell you can't have both together. You get some people that say, you should be looking for capital growth and be prepared to make a loss. So how do you identify the types of properties that are going to give that kind of return? And they do exist because we've got some in our portfolio, but they're not necessarily easy to find.
And they're not easy to find, and they're definitely not an easy outcome to get if you don't have some leverage in the marketplace. So it's very hard for Joe or Joanne Public to be able to go out and get the same kind of outcome that OpenCorp, for example, are able to provide because of our relationships in the market. But the way that we do it, and we definitely agree that you don't have to sacrifice one for the other. Make no mistake, real wealth creation is the capital and compound growth. The cash flow is there to be able to support the holding costs so that you can hold multiple growth-focused investments. I don't know too many people that get $5,000 a year in positive cash flow from an asset that are able to then lather, rinse, repeat that process and acquire a bunch of those properties to give them the kind of outcome that they need. Whereas when the properties grow in value, you can extract that equity and leverage from there. But the process we go through is one of elimination, because while the kind of properties we have invested in over the last 20 plus years haven't changed, our strategies always remain the same, the locations change from year to year and from cycle to cycle. So the first thing that we need to be looking at is which capital city market or markets make sense at any point in time. The kind of things that we look at are obviously the supply, the demand, the macroeconomic factors, specifically median house price movements. There's no point being in a market that's seen growth, significant growth, hence why we're not in Sydney right now. We want to be investing counter-cyclically, coming in before the growth happens. Much better to be 12 months too early than 12 weeks too late in terms of your overall long-term growth outcome. We're only looking at capital cities because supply and demand and affordability at the most basic level drive property markets. And we have the least amount of land and the most amount of people in our major capital cities.
So which capital cities at the moment are you particularly focusing on, and why those particular centres?
Yeah, Melbourne and Brisbane are the two predominant ones, with case-by-case selection in Perth for some clients, depending on their existing portfolios and which markets they have exposure to. There's probably a 60-minute answer in that alone, Alex, but I'll try and give you a couple of key dot points around both. The Melbourne population is forecast to overtake Sydney in the next 10 years or so. So when you're in areas with restricted supply and where the population is being channeled based on government strategy and planning, that gives us a pretty good supply and demand dynamic the way that we want it. Brisbane, clearly from a market cycles perspective, is due to move. Net interstate migration is really high. Affordability is exceptional right now, to the point where at the peak of the market in Sydney in 2017, you could get 2 properties in Brisbane for every 1 in Sydney. So that's why a lot of that, people selling in Sydney, and we've got clients that have done it, moving to Brisbane and buying nicer houses and putting several $100,000 cash in their bank account, and actually getting pay rises in some cases to move based on the job creation up there. There's a snapshot on why Melbourne and Brisbane make sense.
Brisbane has to look really good on paper. We've been waiting for Brisbane to move, and it's really kind of baffled a lot of people as to why it hasn't moved previously. But I think now, just looking at just the difference in terms of price, people's expectations in terms of where they want to live. I mean, the pandemic, which we're all sick of hearing about, has changed people's attitudes. People have realized that they can have more lifestyle-driven sort of focus on where they live, where they work. Even here, we've had a number of people leave here to go and live in Brisbane. Some people working remotely and still working. So things are changing. And I do feel personally that Brisbane, its time is coming up now in terms of there's just some major factors that make it look a very attractive market.
Yeah, Brisbane was due to move pre-17 and was starting to see some increase in land value, which is one of the precursors to establish house growth. Then obviously with the February 2017, when 60% of the purchases in Sydney were interest-only loans, and which is why the government said speculating investors are going to get burnt at the back end of the market. The clamp was put on lending. Well, that impacted the other capital cities. They couldn't isolate and say anyone buying in Sydney has this restriction. It rolled out to all Australia. So Sydney was put off the boil then. Then we saw it post the election. Brisbane just cranked and started to really get some growth. And even it's defied all odds throughout the midst COVID. The numbers I was going through earlier, 400% increase in land sales in areas. That was Brisbane I was talking about. One specific estate in a corridor that we invest in, there was 60 house lots released and 40 sold over the weekend. So we're getting back to camp out type stages again now.
Yeah, it's been building up and it's good to see that, Mark. I mean, I know there's a lot of people tuning in who've backed the Brisbane market over many years and the expectation is going to move. And it does finally feel that it's just common sense says it is on that cusp of moving. Just looking at the capital city, and I know we could talk for hours and hours and hours, but without going down to specifics, are there any particular patterns in the types of assets that you like to buy? What guides you with your clients in terms of where you advise?
Yeah, so two main things that we really focus on. The first is land-based investments. Land's the part that grows. So there are no apartments here. Too much of the purchase price is in the part that drops in value. And secondly is the target demographic that we look at, which is really the cornerstone of that risk mitigation on the cash flow side of things. So suburban houses in existing suburbs is what we focus on. They have that land component. The family tenant is going to be far more stable than the apartment tenant. And hence why we've seen with the restriction of supply during COVID, vacancy rates coming down almost across the board in these suburban areas under 2%, under 1.5% in a lot of cases, and even under 1% as well in certain corridors. So when you start to get that real tightening of rental supply, that's a precursor for people to be considering buying. The established housing market starts to move as a result. These are common indicators that we look at. So the other thing with the family tenant, they're much more likely to stay put and find ways to stay in the property, even during downturns, if the kids are in school nearby. And if you have a family tenant, quite often you're going to have 1.5 or maybe 2 incomes within the family. Hence why, over 90% of our clients, as Cam said, saw no impact whatsoever to their rental income, because affordable rent at an affordable price point was easily doable based on the family dynamic, where it wasn't if you had a single or a couple of friends living together in a city apartment. Much more instability there with your rental income and your target tenant.
A lot of our listeners are experienced investors and a number of them have, so there's fairly significant portfolios, but we do get people tuning in who want to go into property investment for the first time. And just before we close off, I just want some takeaways for you, for people who are looking to move into the market, not just about confidence as to where to invest, but really what do they need to have to make their move? I'm talking about in terms of having deposit, having their financials ready. Just give us a bit of an overview as where you should be positioned if you're looking to take advantage of this marketplace.
The first two things that people need to do is actually what they need to do before they even start thinking about what they're going to buy. And the first is what they want their investment portfolio to achieve, and try and get that as specific as possible, as opposed to just create some wealth or, aim for financial freedom. Something really specific in terms of what they want to achieve, because that will then allow them to ensure that they are adding the right kind of properties to their portfolio in line with the strategy that will deliver the result thereafter long term. The second thing is do their due diligence around their borrowing capacity. So understand what a lender will lend them. My recommendation would be don't go directly to the bank that you've been using since you were a child or the one that your parents used. Go to a broker and get a full array of options, because not all of the banks assess borrowing capacity the same way. If you get knocked back from one bank in terms of a borrowing capacity, be persistent. Again, they're not all assessed the same. Understand and ask the questions around what held you back from a particular lender, and see if you can maximize that somewhere else. Brokers that have experience in working with lenders focused on investment will guaranteed be able to get you a better outcome than someone that just specializes in home loans. So they're the two things that they really need to start with. And once they understand what they can borrow, then it becomes a research-based decision on where they buy the best possible property based on their circumstances right now, getting the market area property formula right, and most importantly, making sure they're mitigating risk around vacancy to ensure that the cash flow is always coming in.
With the process that Boz has talked about, we've named the MAP process, market area property. So it's the reverse way most people pick properties, and people can jump on our website, opencorp.com.au, and grab a free copy of My 4-Year-Old The Property Investor. And in that book, it's got the MAP process, but it's also got the check sheets people can use to keep themselves safe when they're actually selecting and going through, knocking out capital city markets that are not good for investment, knocking out growth corridors that don't have the population growth and supply limitations, and then finally the optimum size and quality property for any area. So feel free to grab a copy of that, and that should keep most rookie investors safe.
We're after specific tips, Alex. The one thing I would encourage people not to do is don't go and buy around the corner from where you live on a whim because you see a property advertised for auction. Number one, it makes no sense to have all of your eggs in one basket in terms of hoping that the suburb that you're buying and or living in is going to grow. Secondly, I don't know a property that goes up in value any quicker if you drive past it every day. The reason why people buy close to where they live is a comfort thing, because they don't have a proven selection process to give them the confidence around why they're buying and why that provides the growth potential. So do the due diligence, understand what that roadmap looks like. As Cam said, you can get the check sheets from our website, do it yourself if you wish. We've got the power of a research and acquisitions team that does it. And that's why our clients have beaten the market by 37% over the last 10 years. So we call it the MAP process. It works. Get those check sheets and buy following a proven process as opposed to an emotionally based decision.
I think you're absolutely right. Myself and Phil believe very strongly in having a team. And I think there's nothing worse than buying around the corner. You'll be phoned up all the time to come around with your screwdriver and your hammer and to go and be a handyman, which I'm dreadful at. But the second thing is, property is, in many ways, it's a very simple way to invest. And I've done far better in the property market than I have done in any other types of investment. But on the other hand, it still requires a team around you. And you point out having a mortgage broker, it's critical. Having a mortgage broker, we've always used buyers agents to help us in terms of choosing where to buy, to make the right decisions. We have an accountant. We have a team of people around us that help ensure that we make the right decisions. So, I think surround yourself with smart people who know what they're doing. You're going to make good investment choices. Quickly, just ahead for next year, looking a lot brighter for everyone. It's going to be a good and a positive year. You're looking forward to 2021?
I usually have the property market with rose-coloured glasses, but they're not the Bono glasses I've usually got. I've got those big Elton John ones on at the moment, mate. So I'm looking fairly bullish at the market.
Yeah, I'd agree. It's been a challenging 3.5 to 4 years for investors that have wanted to add to their portfolio, but been limited with borrowing capacity. We're not one to kind of make these, short-term predictions, but we're keeping a lid on the excitement levels. But no doubt, I'm sure we'll look back. 2021 and beyond is going to be a good time for investors in the market for all the fundamentals we've talked about. So looking forward to it. Guys, thank you so much for taking time to catch up with us. Michael, Cam, been a pleasure having you on the show. We'll get you back next time in person. Once we're COVID-free, once everyone can travel easily, it'll be a pleasure to have you in the studio. Yeah, look forward to it, Alex. We're well overdue for a beer or coffee, so we'll catch up shortly. Thanks, guys. For everyone else, thanks so much for tuning in. Really appreciate having you with us. I hope you found today's show insightful. A lot of good takeaways there. Do please get in contact with us. We do love to hear your thoughts. Phil is the host of the show. He loves to know what you think about the show. Leave us feedback on the podcast. Give us a scoring. If you like the show, score it high. Don't forget to check us out. We're on all the usual social media. And tune in next week. Thanks very much for joining us.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.